Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we are discussing whether it is a good idea to invest in an apartment. These are my thoughts. This is the how I come to derive on why I believe units are probably one of the better asset classes, especially when you're starting out in property investing and also building the portfolio to ultimately land in blocks of apartments. Before we go through the ins and outs, a couple of backstories of some key iconic real estate investors. First of all, Harry Triguboff. He is the biggest property investor in Australia. He's worth estimated up to 28 billion. He created his fortunes in building high-rise apartments. He started off in his late 20s, early 30s. Originally, he had a milk run and a taxi, and he saved up enough money out of those two businesses to build a block of 4 apartments. So a modest beginning in property, started by building four units on one site, and then started building multiple sites, blocks of fours, blocks of sixes, eights, tens, 12s, 20s, 100. These days, he's now builds typically no less than 1,000 apartments in each site, 1 to 2,000, where he buys sites, builds 2,000 odd units, sells off half to pay off the land and the construction costs, and then keeps the other half as a cash flow and runs Meriton Suites, so serviced apartments. So he's the biggest investor, property investor and developer in Australia, and one of the most wealthy people in real estate in Australia. And his portfolio consists of 99, 98% in high-rise apartments. So perfect example how the product definitely works is Harry's story. There's always a demand for apartments. You always have a tenant. You typically don't go longer than 3 to 4 weeks without a tenant. They are very resilient. Even during downturns, the bottom end apartments continue to outperform and grow to the next level as people sort out for affordable accommodation. There's never enough supply and there's always a demand, especially in Australia with net migration running these days anywhere between 350 to 500,000 a year. People need places to live, they need a roof over their heads, and affordable accommodation such as apartments are always in demand. Another iconic apartment builder, the Trump organization. So starting off, Frank Trump on the right-hand side, which is Donald Trump's father, began in Brooklands, in Queens, in New York, building apartment buildings or houses, and then eventually into apartment buildings, affordable accommodation, affordable apartments for himself, but also the government. And then Donald Trump came into the business in the 70s and took it to the next level in Manhattan, in New York, and built high-rise apartment buildings, Trump Towers, as he labels them. So another prime example of how apartments are definitely a solid investment on a small scale, but then ultimately you can scale up to massive scale, such as what the Trump organization does these days. They build high-rise buildings of apartments. They then also invest in other assets such as golf courses and hotels. But their core business is in the high-rise apartments. Even during the 90s recession, where Trump went through a lot of pain with his casinos that switched off and stopped bringing in any income, his high-rise apartments was the backbone of his organization that ultimately got him through the tough times. So again, another classic example of how apartments are a key investment that can definitely get you to the ultimate levels of wealth. So we have a specific caveat to buying apartments. We don't suggest going and buying any new and off the plan. That's developers' stock. Typically, when you go and buy new and off the plan, you will overpay, as the developer pretty much dictates the price of their product based off the cost of the land, the labor, materials, cost to build the apartment, the interest holding costs, the tax, the profit all goes into their final product. And we don't suggest buying, new and off the plan apartments for $1 million plus. Typically, it costs around minimum 600,000 to build an apartment these days. So we like to buy for significantly less than the replacement cost, being less than the intrinsic value, because that's where we see value. And if you can pick up properties for half the cost to build, it's only a matter of time that the prices that you pay will realign to the intrinsic value and then even exceed it during the boom phases. So key reason, yeah, we don't buy new and off the plan, as you'll pretty much overpay the market value and then be holding it for many years, 10, 15 years before the market moves to the next level for you to then build any substantial equity. And we're not sold on the tax depreciation, the locations such as, if they're in growth corridors. That's all smoke and mirrors. If you're looking to build a sustainable long-term portfolio, you have to stick to established properties that cash flow better, that have significant upside to their growth potential, and definitely steer away from buying new and off the plan. So this is the typical style of apartments we like to get into. Classic two-story walk-ups with minimal landscaping, no gyms, lifts, pools, even no balconies. As you can see, this asset is pretty basic. Really, the only risk with these types of asset is the roof, but every property needs a roof, and plumbing works really. And we like to pick them up in areas that have a mix of both houses and blocks of apartments, so it's not super high density, and smaller blocks. So we say less than 25 in a block, but the sweet spot is probably between 8 to 16, but less than 25 in a block is good. When going established units, you can buy them for under the intrinsic value. So as I said before, it costs around 600,000 minimal these days to build a unit, and up to $1 million for the high end. So we pick up units for sub 350, sub 300 in Melbourne currently now, and sub 350 in Sydney. So when you're buying a unit for half the replacement value, it's only a matter of time that the price you pay will then realign to the intrinsic value, being the replacement cost, and then even exceed it during the boom phases. So these units we're picking up now for around the 300,000 mark, within the next 5 years will be worth 600,000-700,000. Strong yield, second point. So we say minimum 5% rental yield, but ideally 6 plus, 6-7%. We can find between high sixes to mid sevens on purchase price, and then once you turn over a tenant, so vacate the tenant, do minor cosmetic renovations, paint, flooring, maybe replace a kitchen. That's when you can really start pushing the yields as high as 9-10%. Once you put the property back on the market after minor renovation, boost the rents, that then higher rents get capitalized into high price, and then the banks will throw money at you to refinance the loan, borrow your deposit plus closing costs back, plus even more in some cases, and then keep reinvesting into your next deal. Low maintenance complexes. So as I said, no gyms, lift, pools, and even no balconies, ideally. So nothing sexy, nothing flash, just fundamental, affordable accommodation, low maintenance, minimal landscaping, so it's low strata fees. We see strata fees typically picked up between 350 at the minimal strata fees per quarter up to about 700-800 a quarter, but on average around that $500-600 per quarter, which covers the cost of insurance, maintenance, upkeep, management of the building structure and the common areas. So it is definitely worth the money spent, especially if it's 400, 500 a quarter. As when you own them interstate, it's always a good to have an additional layer of management on top of your property manager that's maintaining the whole complex and managing the facility. So it's definitely worth the money, and insurance is covered in it as well. So when there's ever major or any minor maintenance works required to the building, it's all covered by the strata. And sometimes there may be a special levy if there's not enough funds on the balance sheet, but typically they're well maintained and managed with the cost of the strata fees. We like to buy in a market that is set for its next growth cycle. So we invest based on the 18-year land cycle. The 18-year land cycle consists of 14 years of expansion and 4 years of contraction. In the first half of the cycle, Sydney, Melbourne lead. They then have a spillover effect into the regions, their respective regions in New South Wales and Victoria, as people get priced out of Sydney and Melbourne. And then once people are priced out of Sydney and Melbourne and then the regions, people then start looking at the more affordable metro markets during halfway through the upturn, so around the mid-cycle slowdown period. So that people then start looking at Brisbane, Perth, Adelaide, and then come in the later half of the cycle where we are now, that's when people start to spill over from those smaller metros, being Brisbane, Perth, and Adelaide, into their respective regions, and that's when the regions then go for a solid run as well. And then the market tops out. All the regions are once they're all hitting their limits, everything's hitting its limits, and the market will turn through the next global financial crisis, which we believe is due in 2027, at which point Sydney and Melbourne then lead again in the recovery in the next cycle. So that's why we are now sowing our seeds down in Sydney and Melbourne in preparation for the next growth cycle, rather than continue buying in, say, Brisbane, Perth, or Adelaide, which are hitting their limits, as you'll overpay now the intrinsic value, and then you'll be waiting for many years, 10, 15 years before the next growth cycle in the second half of the next 18-year land cycle until you'll get any substantial capital growth. So that's why we like to invest counter-cyclically, sow your seeds in the soft markets, and then ride their growth cycles, refinance or renovate or develop, add value during the boom phase, and then once the market tops out, you then have options to refinance, pull your money out, put it into the next market, or even sell down to pay off the debt, raise cash, reinvest into larger blocks of units. So growing population. So these are the large regional areas, or any metro market will have a growing population, but some of the regions can be a little bit tricky. Just got to make sure that they have consistent long-term population growth, as the population will put pressure on housing. When an area gets overpopulated, it soaks up all housing stock. Then there's more demand than supply. That then pushes pressure up on prices, and it continues to keep the housing market performing strongly over the long term. Is population growth. It all comes from population. And in a suburb that will gentrify. So classic examples of gentrification is when an area transforms from a lower class area into a middle and upper class. This is done by when investment is invested from the government. So public investment is invested into an area, such as new roads, new train stations, new metro lines, schools, hospitals, amenities are all upgraded. Where there has been a lack of investment historically, And then once the public investment goes into an area, the government may even sell off government housing and then buy other sites to build other suburbs and keep moving people in government housing to other areas to raise cash in the more premium suburbs to then reinvest into more affordable areas as they continue to grow and build more estates. Once that public investment has been deployed into an area, that will then spur on and attract private investment to buy up old sites, knock down old rundown houses to build new blocks of apartments, new commercial space. Then all of a sudden there'll be nice bougie restaurants and bars popping up, and the whole economy of that suburb completely gentrifies and transitions into a new area, a new economy. So classic examples in Sydney, Redfern, Surrey Hills, back in the late 80s, early 90s, rough suburbs, but due to the light rail that's gone through there, upgrading the schools, roads, infrastructure, that's then spurred on private development. Government sells off government housing. Now the Redfern, Surrey Hills are completely transformed into new economies and new suburbs. These days, so back in that late 80s, early 90s, you could have bought terrace homes for 100 to 150,000. These days, those same terrace homes are going for $3 to $5 million. So the significant growth within a short period of time is definitely fueled by gentrification. So we like to target the blue collar working class suburbs that are close to the metro CBDs, that have the infrastructure, that have the future infrastructure projects as they'll gentrify over time. And then you can get in today for less than intrinsic value, they cash flow, and then over time they have significant growth as the suburbs gentrify and convert into new economies. And then in 10, 15 years time, you would look back and think, shit, I wish I bought another 10 or 15 of them. So that's gentrification in a nutshell. I guess the key benefits of buying an apartment is you diversify your risk with the other unit owners. So when you buy a house, you own the whole site. You're responsible for maintaining the whole property and the whole site. So if the roof goes, that's all on yourself. That could be $100,000 job. Or if you even buy a block of units and you maintain the whole site, when you buy a singular unit within a complex, you're diversifying your risk across all the other unit holders. So if the roof goes, it's typically $100 a square meter. So max it would really cost a unit holder within a 10 or 15 unit complex would be $5,000 to $6,000, $7,000 per unit to replace a roof. Versus if you're the only person that owned that property, then it would be all on yourself and it'd be 60, 80, $100,000. So that's the benefit of, I guess, diversifying in an individual complex, but then also spreading your capital across multiple markets. So rather than buying $1 million house, you could buy 3 or 4 units in 3 or 4 different markets. So you're diversifying, you're not putting all your eggs in one basket, and you're playing each market and getting a solid diversified growth perspective, but then also diversifying across states will then reduce the risk of government policy. So right now we're seeing Victoria getting smashed by land tax because their land tax threshold is at 50,000 versus New South Wales and Queensland states are around the 900 to $1 million threshold. So if you had all your eggs in one basket being Victoria, then you'd be feeling the pain versus if you spread your capital across two or three states, then you're diversifying also against government policy, which can change within within the years of government being elected, whether it's a Labor or Liberal government, and depending where we are at in terms of the 18-year land cycle. Because typically and historically, towards the end of the cycle, when prices continue to keep rising and there's a wealth divide between people who own property and people who don't, there's a tendency to shift towards policy that is more favorable for tenants and not as favorable for landlords as the wealth divide continues to grow. So during this period of time, it can be seen as a higher running cost due to policies making, but once the market turns in 27, 28, that will then typically shift back to a more neutral stance as the market equalizes again and resets and then continues on its next cycle. So also another benefit is banks prefer this asset class, again, from the diversification perspective. It's not considered as a risky asset class if you buy the right unit in the right market at the right price point at the right time, and not in those massive, huge high-rise complexes. We don't advise buying in those. So banks love them. They've got a high, strong rental yield, so it allows the banks to keep lending you more money and keep growing your portfolio. They're like throwing kindling on a fire. They bring in solid growth, solid cash flow, and there's not much debt that you really need to buy an individual unit. Strata fees include insurance, maintenance, upkeep of the building and the common areas. So that's a benefit. And as I said before, the other benefit is when you own them in the States, you've got a third party organization that's in their interest to keep the complex well maintained and keep away any criminal activity or anything like that. So it's definitely worth the strata fees to keep the complex nice, well maintained and upkept to make sure that the appeal of the complex is high in regard, so then it attracts good tenants, pays rent on time, it then filters into the growth and the value of the site. Lower land value is also a benefit. So when you're buying in a complex, you don't own the whole site. It's split up between the unit holders. So typically the land value is anywhere between, say, 50 to 100 grand. So the land tax is less. You can buy a lot of them, get a good strong rental yield, get a good strong cash flow, get good strong growth if you're buying them for less than the intrinsic value. And then over time, you're not eating into your land tax threshold. So it's costing you less to run them rather than owning a whole site that's worth $1 million. Then you're costing you more land tax to Uncle Sam. So that's another good benefit that people oversee, I believe. And they're always in demand. 2 bed, 1 bath, 1 car space. You can never go wrong. You got pretty much everyone in the market, from first home buyers, investors, downsizers, upgraders from tenants. There's always a demand for 2 bed units, and even more so when the market turns throughout the downturns. When we go through the COVIDs or the GFCs or the dot-com busts, when people lose their jobs, they can't no longer afford $1 million plus fancy house if they've got a big fat loan or they're renting it. So what do? They look for affordable accommodation. Lots of people flock towards affordable accommodation during times of crisis. And then that shift in demand, the supply doesn't increase because we're typically in a crunch period. So developers go back into their shell and hibernate for a while just to get through the tough times. So there's not an increase in supply, but there's a massive demand shift during a time of crisis. So what happens is the bottom end, the entry level stock, continues to outperform and go to that next price point level, even when the top end in town is coming off. So all the blue chip, fancy homes, shiny stuff, all the new and off the plan is getting smashed. Stock market's getting smashed, halved. Crypto will be getting wiped out. Everything top end will be getting wiped out. Everyone's super stock market's getting smashed, but the affordable blue collar working class 2 bed, 1 bath, 1 car space units will be powering on from the current level to the next level, even when everything's softening. So there's never a better time now, I believe, to invest in this stock. If you're looking to get started, or if you already have a couple of properties and you're looking to complement, they're like throwing kindling on a fire. They'll definitely set you up to get to that next level. Just a bit of disclaimer. I mean, this content is just general in nature and by no means personal, financial, or general advice. Prior to making any investment decision, you should seek independent legal, tax, property, investment, Advice, I operate as a buyer's agent though. If this resonates with you and if you want help building a 10 plus property portfolio, hit me up, send me an email. I can send you some more details of how we operate as a buyer's agent, help you on your way, send you a 10-year roadmap, which will get you to 10 properties. It's easy enough done, even if you're not on a big wage. You only really need to be on 80, 100 grand household income if you use this strategy called the Williams Real Estate Strategy, 10 properties within 10 years. Until next time, thank you for watching.